All right, let's talk about one of the biggest paradoxes in investing, these high-growth emerging markets. I mean, everybody wants a piece of that action, right? But there's a whole other story lurking just beneath the surface. And honestly, it's something every smart investor absolutely needs to understand. So let's just dive right in.
First things first, just look at the numbers. They're pretty hard to ignore. We're talking projections that show emerging markets growing at 4 to 5%. That is literally double the rate of so-called advanced economies. Now that is a gap that's going to get anyone's attention.
So that begs the obvious question, doesn't it? If the growth potential is just that massive, why isn't every single investment dollar on the planet flooding into these markets? What's the catch? There has to be a catch.
Yeah, the pull of those growth numbers is powerful. I get it. There's no doubt about it. But as we're about to see, that amazing allure, well, it's only one side of the coin.
So what is it? What's holding people back? Well, it all boils down to one word: risk. And more specifically, the kinds of risks that are tied to restrictions on the free flow of capital. You can think of it as friction in the system. All these hidden costs and dangers that can turn what looks like a golden opportunity into a total nightmare.
So how on earth are we supposed to make sense of all this complexity? Well, thankfully, we've got a guide. Finance professor Andrew Caroli, in his book Cracking the Emerging Markets Enigma, actually developed a framework to identify and, get this, quantify these risks. He basically gives us a clear lens to see what's really going on. Okay, so let's get into the nitty-gritty. We're going to walk through the 6 core risk factors that Caroli identified. You can think of this as, the engine room of his entire framework.
So here they are, the big 6. The best way to think about these is like a report card for any country's investment climate. We're going to break them down one by one.
First up is market capacity constraints. This one's all about size and agility. Can the market actually handle a big influx of money without going haywire? Is it big enough? Can you get your money in and out easily without causing massive price swings? It's a huge deal. And to make this really concrete, just look at the difference here. On one end of the spectrum, you have a place like Venezuela, where the markets are tiny, they're illiquid, it's just really tough. But on the other end, you've got Taiwan, with this huge, vibrant, deep market that honestly looks more like a developed economy than an emerging one. It's night and day. Okay, next up, operational efficiency. This is all about the cost of just doing business. We're talking about everything from the obvious stuff like commissions and taxes to the more hidden costs, like how wide the bid-ask spreads are. Basically, how much of your potential profit gets eaten up by all that friction. Number 3 is foreign accessibility. I mean, how easy is it for someone like you, an outsider, to even get in the door? This covers the direct legal barriers, things like ownership limits, but also what the source calls these indirect hassle factors. You know what I'm talking about, the bureaucratic red tape that just makes investing a total headache. All right, 4th on our list, and trust me, this is a big one: governance and transparency. Do companies operate out in the open? Are their accounting books actually clean? And maybe most importantly, are minority shareholders protected? Or are a few powerful insiders just calling all the shots? At the end of the day, it comes down to, can you trust what you're seeing? And here's a really fascinating little detail. A key indicator for this is something called synchronicity. That's when all the stocks in a market tend to move up and down together in lockstep. It's often a sign that there isn't much good company-specific information out there, a huge red flag for poor transparency. And apparently, on this specific measure, China scores particularly poorly. Number 5, legal protections. This is crucial. If a deal goes south, can you actually rely on the courts to have your back? Is there a strong, independent legal system that's going to protect your rights as an investor? Because without that, you're basically just investing on a prayer. And finally, the 6th risk. And it's the one that's probably top of mind for most people: political instability. This covers all the obvious stuff, right? Violence, civil unrest, but it also includes the more subtle but just as dangerous risks of corruption or a government that might just wake up one day and decide to completely change the rules of the game. So there you have it, the 6 risks. But the real magic of this framework isn't just making a list. It's what happens when you start to put it all together and actually compare countries side by side. Because the results, well, they can be really, really surprising. What it does is it forces us to look past these simple, easy labels that we use every single day. And it makes us question what we think we know about which countries are risky and which ones are safe. So let me just ask you this directly. When you hear the term emerging market, you think risk, right? And when you hear developed market, you probably think safety. But is it really that simple? Is it always that black and white?
Okay, prepare to have your mind blown a little bit. If you look at just one metric, governance and corporate transparency, Slovenia, a country most people would definitely label emerging, actually ranks higher than economic juggernauts Japan and Germany. Just let that sink in. That one single data point completely shatters that simplistic emerging equals risky story.
So all of this brings us to the most important part. What's the big takeaway here? What does this actually mean for you as someone just trying to make sense of the global economy?
The real truth is this. Risk is not some on or off switch. It's not just developed over here and emerging over there. It's a whole spectrum, with way more nuance and shades of gray than those simple labels ever let on.
So, if you're going to take away anything from all this, let it be these key points. First, high growth absolutely does not equal low risk. Second, risk is complicated. It has many faces, so you have to look beyond the headlines. Third, those simple labels we use, like emerging, can be incredibly deceptive. And finally, using a structured framework, like the one we just talked about, is really the only way to get to the true picture.
The source material really says it best. Just because a country is labeled an emerging market doesn't mean it is an emerging market from a risk standpoint. The name on the box doesn't always tell you what's actually inside.
And that really leaves us with one last question to think about. It's so easy to get mesmerized by the promise of explosive growth, but the smartest people, the smartest investors, are the ones who soberly and carefully assess the reality of risk. So the crucial question is, which one are you focused on? Thanks for joining me.
Wow.